the engine powering the AI revolution. It's not just clever code, is it? It's a mountain of hardware.
Exactly. A huge amount of physical stuff.
And today, we're doing a deep dive into the performance of one of the key companies actually building that infrastructure. Yeah. Supermicro Computer or, SMCI.
Right. We've gathered a whole stack of information, their latest earnings reports, analyst takes, news articles, the lot to really get under the hood of what's happening with this pivotal player in the AI boom. We want to see what the future might hold.
And just for context, if you're maybe newer to this, SMCI isn't your, let's say, typical tech giant. They're really specialized high-performance server tech.
Yeah, the kind of heavy-duty gear you need for AI and machine learning, for high-performance computing, big cloud setups, massive storage, even 5G and edge stuff. It's essential.
So to get the clearest picture, we've looked closely at their Q3 fiscal 25 earnings. That includes the preliminary warning they gave, the full report that followed.
And also their investor presentations, what management said on the earnings calls, plus a range of analysis from financial experts and recent news coverage.
So the mission today, for you listening, is really to navigate the complexities here. You've got a company like SMCI right at the heart of this massive AI wave. But as our research shows pretty clearly, there are some big opportunities, but also some very real hurdles.
Definitely.
Okay, so let's unpack this, starting with those recent earnings. Fiscal Q3 2025. Sounds like it was a bit of a bumpy ride.
That's putting it mildly, perhaps. The first heads up came back on April 29th. They basically signaled a much weaker quarter than everyone expected. Big cuts to their forecasts for revenue and earnings per share.
And the market reaction. Predictable, I assume?
Oh, yeah. Negative. The stock took a noticeable hit right away. Investors clearly weren't happy with that news.
Okay, so that set the tone. Then the full earnings report landed on May 6th. Did that sort of change the narrative at all? Offer any relief?
Not really, no. I mean, okay, on the non-GAAP earnings per share, they did slightly beat that new lower forecast they just set.
Right.
But crucially, it confirmed that big revenue shortfall. And the market reaction stayed negative, which suggests investors were still focused on the, fundamental business slowdown.
Okay, let's get specific then. Drill down into those Q3 numbers. What did the key financials actually show?
Right. Revenue came in at $4.6 billion. Now, on one hand, that's up 19% compared to the same quarter last year. So year-over-year growth is there. But it's a significant 19% drop from the previous quarter, Q2, and a really big miss compared to their original guidance, which was aiming for somewhere between $5 and $6.0 billion.
Ouch. Okay. And how did that flow through to the bottom line, the profitability?
Well, non-GAAP diluted earnings per share, EPS, was $1.31. That's quite a bit lower than the $1.66 they reported in Q3 last year, and also down from Dura 59 cents just the quarter before.
So even though it beat the revised lower target.
Exactly. It beat the lowered bar, but it was way below what they originally thought they'd make. And the GAAP EPS, the standard accounting measure, was even lower at 17 cents.
And margins. Always a key focus.
Always. And yeah, they definitely took a hit. Non-GAAP gross margin was 9.7%. Now, compare that to 11.9% last quarter and 15.5% in Q3 of 24. That's a pretty steep decline.
Wow. Yeah.
And the non-GAAP operating margin also slipped down to 5.0% from 7.9% in Q2. So yeah, the cost of actually generating that revenue seems to be climbing.
Okay, so clear pressure on profitability.
Yeah.
Were there any brighter spots in the numbers? Anything positive?
Yeah, there were a couple, yes. Their cash flow from operations looked pretty strong and improved significantly from Q2, hitting $627 million.
Right.
And they also generated positive free cash flow, about $594 million for the quarter. So they are bringing cash in the door.
Got it. So better cash flow generation, but offset by weaker revenue and those shrinking margins.
Yeah.
What did management say was driving this sort of mixed performance?
Well, the main story from the company was customer purchasing delays. Apparently, a lot of clients were hitting pause, waiting for NVIDIA's next-gen Blackwell GPU platform to become widely available.
Ah, the classic tech transition pause.
Exactly. But it's worth noting, even with those delays, AI GPU platforms still made up over 70% of SMCI's total revenue. So it really underlines how central AI is to their business.
Okay, so anticipation for the newest, hottest chips caused a temporary slowdown. Makes sense. What about those falling profit margins? What was the explanation there?
That was pinned on a couple of things. First, they had inventory write-downs on their older generation GPUs, clearing out the old stock.
Right.
And second, they faced higher accelerated costs as they were ramping up production and getting ready for these new Blackwell system launches, expedite fees, things like that.
That seems logical.
Yeah.
Clearing inventory, investing in a new product ramp, standard stuff. But it hurts margins short term. Did different parts of their business perform differently? Any major variations?
Yeah, there was a pretty clear split, actually. Their enterprise and channel segment, that's, sales to smaller and medium businesses, often through partners, that part was strong. It grew 38% compared to Q2.
Okay.
That brought in $1.9 billion, making up about 42% of their total revenue. So, decent demand there.
But the other side of the house.
Correct. The OEM appliance and large data center segment, think big cloud providers, large corporations, that part saw a big drop. It was down 38% compared to Q2, falling to $2.6 billion.
Even though it's still up year over year.
Yeah, still up 35% compared to last year, but that sharp sequential decline really shows where those customer purchasing delays hit hardest. Mostly with the bigger clients. It accounted for 57% of revenue.
And it's important to remember, as the sources highlight, SMCI does have quite a bit of customer concentration, doesn't it? A few big fish in their pond.
Absolutely. The Q3 report showed that their top two customers were responsible for 22% and 14% of revenue, respectively. That's quite significant.
Yeah, 36% from just two customers. That definitely adds a layer of risk if anything changes with those relationships or their spending.
Exactly.
So, given all this, what was the tone from SMCI leadership? What do they say about the outlook?
Well, the CEO expressed, strong confidence in their long-term growth. The message was basically that these delayed deals aren't lost. They're just pushed out and expected to close soon.
Okay.
They also really emphasized their speed to market, highlighting that they were among the first shipping systems with the new NVIDIA B200 and AMD MI325X chips.
And the actual numbers. What did they guide for next quarter, Q4?
For Q4 fiscal 25, they're projecting revenue to bounce back, landing somewhere between $5.6 billion and $6.4 billion.
So sequential growth again.
Right. And non-GAAP EPS is expected between 0.40 cents and 50 cents. But interestingly, they guided gross margins to stay around 10%.
Okay. So revenue rebound expected, but that margin pressure looks like it's sticking around for Q4 at least. What about the full year guidance? Did that change?
It did, yeah. They revised their full fiscal year 25 revenue guidance down again. Now they expect between $21.8 billion and $22.6 billion.
And that's down from?
Down from the previous range of $23.5 to $25.0 billion, and way down from their initial much higher forecasts earlier in the year. So yeah, the year is definitely ending weaker than they first hoped.
Okay. A really mixed picture of that. Management sounds optimistic long-term, but there are clear short-term bumps and persistent margin issues. Let's zoom out a bit and look at the bigger financial trends. This period of, explosive growth seems to have hit a wall in Q3.
You're absolutely right. I mean, look at the last 5 years. SMCI's revenue growth has been phenomenal, averaging almost 45% annually.
Yeah.
Just before Q3, their trailing 12-month revenue was over $20.8 billion. Huge numbers.
But that consistent quarter-over-quarter climb.
Yeah, that pattern definitely broke in Q3 with that 19% sequential drop. It's a significant interruption to that rapid growth trajectory, something investors really need to note.
And this latest downward revision for the full fiscal year, that must cast some doubt on those really ambitious long-term targets they've talked about, like hitting $40 billion for fiscal 26, right?
It certainly makes the path steeper. Achieving those kinds of targets now requires a, significant reacceleration from where they are now. It adds a layer of uncertainty for sure.
Okay. Now, profitability. We touched on it, but let's dig in a bit more. Those declining gross margins seem particularly concerning.
They are a key point, yeah. That drop from 11.9% non-GAAP gross margin in Q2 down to 9.7% in Q3, and especially the fall from 15.5% a year ago. That's substantial.
And the drivers again were?
The inventory write-downs on older GPUs, plus those higher costs getting ready for Blackwell. But importantly, the guidance for Q4 suggests margins stay around 10%. That implies this pressure isn't just a one-off blip. It might linger.
Which raises the question. Can they sustain healthy profits with margins at these levels?
Exactly. That's the core question. And this pressure flows down, obviously. We saw the non-GAAP operating margin dip, and their GAAP net income, the standard profit measure, fell a dramatic 73% compared to Q3 last year.
Wow.
And while their adjusted EPS growth has been strong historically, the forecast for this full fiscal year points to a major slowdown in that growth rate.
Our sources also mention a widening gap between their GAAP and non-GAAP EPS. What's behind that difference?
It's mainly two things. Stock-based compensation expenses, which are non-cash but dilute shareholders, and costs related to paying off debt early, debt extinguishment. Investors need to look at both numbers to get the full picture.
And it's worth remembering, SMCI's gross margins have typically been lower than competitors like Dell or HPE, haven't they?
Yeah, structurally lower. It's often linked to their business model, more focused on high-volume hardware assembly, less on higher-margin software and services compared to those bigger, more diversified players.
Okay, let's pivot to the balance sheet and cash flow. You mentioned cash flow was a relative bright spot in Q3.
It was. That $627 million in operating cash flow was definitely positive. And they ended the quarter with net cash, meaning cash roughly equaled debt, though it was a fairly modest position.
But inventory levels went up.
They did. Inventory climbed to $3.9 billion. That's something to watch. It could be strategic, building up for expected Q4 shipments.
Or it could be a risk if those shipments don't materialize as strongly as hoped.
Precisely. Managing that inventory effectively is going to be really crucial to avoid more write-downs down the road.
Okay, so summing up the financials. History of amazing growth hitting a speed bump, serious margin pressure, decent cash generation, but rising inventory. Now, let's talk about why everyone's so interested in SMCI, the huge AI growth opportunity. They seem really well positioned, right?
Oh, absolutely. They've carved out a major spot in this booming AI server market. They're right there competing with the big guys like Dell, HPE, and also the ODMs, the original design manufacturers who build servers directly for the hyperscalers.
And their success seems tied to being nimble.
Yeah, their agility and focus on high-performance systems really let them catch the wave of generative AI demand effectively.
And they've grabbed significant market share in AI servers.
Some analysis suggests their share jumped dramatically, maybe from around 10% in 2023 up to potentially 23% in 2024. That's a massive gain. And like we said, over 70% of their Q3 revenue came from AI GPU platforms. It just shows how central they are to this build-out.
A big part of that seems to be their relationship with the chip makers, especially NVIDIA.
Definitely. That NVIDIA partnership is key. It gives them early access, allows them to quickly roll out servers with the latest GPUs. They made a point of saying they're shipping Blackwell systems in volume already, claiming first to market on some configurations. They're really ramping up production now.
But they're not just an NVIDIA shop, are they?
No, they're working closely with AMD, too. They started shipping systems with AMD's Instinct MI325X GPUs in Q3 and have plans for the next-gen MI350 chips. It gives them and their customers options, diversification.
Another big advantage mentioned is liquid cooling. That seems increasingly important.
Hugely important. As these AI chips get more powerful, they generate incredible heat. Liquid cooling is becoming almost essential for dense AI deployments. SMCI has built real expertise here in direct liquid cooling, or DLC.
They've shipped a lot of these already.
Thousands of racks, yeah. And they're rolling out next-gen cooling tech specifically for the demands of Blackwell. This know-how is a significant strategic plus.
So it sounds like a combination of speed, partnerships, and this cooling tech gives them an edge.
I think so. Their building block solutions approach lets them customize and deploy fast. They have a wide portfolio. The in-house liquid cooling is a differentiator. And they're expanding their manufacturing globally, too, which helps with delivery.
And the future growth catalysts seem pretty clear.
Yeah, it hinges on the successful ramp of these new Blackwell and AMD MI350 servers. Plus, continued strong investment in AI infrastructure overall. Gartner, for example, predicts another big jump in data center spending next year.
And broader enterprise adoption of AI.
Right, beyond just the hyperscalers. And, of course, the increasing need for liquid cooling itself. If more data centers move that way, SMCI is well-placed to benefit.
Okay, the opportunity is definitely there. Huge potential. But as Q3 showed, it's not a straight lineup. Let's talk about the risks our sources flagged.
Absolutely. The AI growth story is compelling, but SMCI faces real challenges. We've already talked about the market and financial risks. That margin pressure is a big one. Inventory obsolescence, expedite cost, pricing pressure, product mix. It all plays in.
Plus the revenue volatility we saw, forecasting difficulty.
Exactly, and just being tied to the cycles of AI spending. Plus, you always have the broader economy and geopolitics as potential headwinds.
And the competition isn't standing still, is it?
Not at all. It's fierce. You've got Dell and HPC, massive incumbents with deep pockets and customer relationships. Dell, in particular, reported really strong AI server growth recently.
And the ODMs.
Yeah, companies like Quanta and Winland, especially supplying the biggest cloud players, there's a real risk SMCI could lose share if they slip up on execution or strategy.
What about internal challenges? Just managing this kind of hyper-growth must be tough.
Incredibly tough. Scaling operations that fast is complex. Supply chains can get strained. Component shortages are always a risk. We saw the inventory issue bite them in Q3. And executing perfectly on the ramp of these super complex new Blackwell systems isn't a given. There are definite execution risks there.
And that customer concentration risk we mentioned earlier.
Still relevant, absolutely. Relying so heavily on just two customers makes them vulnerable if those relationships sour or spending patterns change.
Lastly, there were some regulatory and governance points raised in the sources.
Yes. There was that period last year with delayed financial filings, which caused some concern. While they got filed and an independent review found no fraud, their auditor did issue what's called an adverse opinion on their internal controls over financial reporting in their last annual report for fiscal 24.
Meaning the auditor found significant weaknesses.
Correct. They're working on fixing those weaknesses. Remediation efforts are underway. But it's something investors need to be aware of and track progress on.
Okay, quite a list of risks to balance against the opportunity. So how is the market pricing all this in? What's the valuation look like?
Well, looking at data from early May 25, the price-to-earnings ratio, the PE, seems to be somewhere in the low teens up to maybe 17x, depending on the source. The price-to-sales is around 1.
Which, compared to some other high-flying tech stocks...
It seems relatively modest, yeah.
And how does that compare to SMCI's own history? Has it been valued higher?
Oh, yeah, much higher. Valuation has been incredibly volatile. The PS ratio, for instance, peaked way higher back in early 2024 during that initial AI frenzy.
It's come down quite a bit from the peak.
It has. It's below the 2024 highs, but still higher than where it was before the big AI boom really kicked in. Suggests the market sees the AI potential, but is also pricing in more of these risks we've discussed.
How about compared to competitors like Dell or HPE?
Well, as we said, SMCI has lower gross margins. Dell, for instance, often trades at a higher PE multiple. Maybe the market sees Dell as having more stable margins, perhaps lower operational risk, even if SMCI has had faster recent growth.
Now, what's the general feeling among Wall Street analysts covering the stock?
There seems to have been a definite shift after the Q3 report and the guidance cut. More analysts moved to a neutral or hold rating.
So less bullish than before.
Seems that way. While there are still buy ratings out there, a good chunk are now hold. And the price targets analysts have set are all over the map, a really wide range.
What does that wide range tell you?
It screams uncertainty. It shows there's a lot of disagreement about how SMCI will navigate these challenges and capitalize on the AI opportunity. Some targets were cut post-Q3. The median target might suggest some upside, but that dispersion really highlights the lack of strong conviction either way.
Definitely sounds like a divided view among the experts. So pulling all this together, what are the key things someone should consider if they're looking at SMCI as an investment right now?
You really have to weigh the two sides carefully. The bull case is strong. They're in a massive growth market. They have tech advantages like liquid cooling. They're fast.
Versus the bear case.
Which is also significant. That margin pressure is real and persistent. Competition is intense. There are execution risks with rapid growth and new products, and those past governance questions linger.
So the core question is,
can their strengths and the market tailwinds overcome these challenges? That's what it boils down to.
So based on everything we've reviewed, what's the takeaway? What's the recommendation?
Well, for investors already holding SMCI stock, given the long-term potential but also the very real near-term headwinds and risks, sticking with a hold seems like a reasonable approach right now.
And for someone thinking about buying in fresh?
Given the volatility, the margin issues, the execution risks, it feels more like a speculative buy at this point. Suitable only if you have a high tolerance for risk and are looking long-term, really believing they can navigate these hurdles and maintain leadership in the AI build-out. It hinges on fixing those margins and staying ahead.
Okay. And if you were invested or considering it, what are the absolute must-watch factors going forward? What should be on your dashboard?
Top of the list. Gross margin trends. Absolutely critical. Watch if they stabilize or improve. Second, the Blackwell and MI350 server ramp, are they gaining traction and share? Third, competitive dynamics. How are they faring against Dell, HPE, the ODMs?
Also revenue growth and guidance.
Definitely. Keep an eye on their revenue numbers and any future guidance updates, especially looking towards fiscal 26. Customer diversification is another. Are they reducing that reliance on the top two? Inventory levels need to see those managed well.
And the internal controls.
Yes, any updates on remediating those weaknesses are important. And finally, just watch operating expenses. Are they keeping costs in check relative to revenue growth?
Okay, so a really complex, fascinating picture we've painted here. SMCI. Huge potential, right in the eye of the AI storm, but facing some serious headwinds too. Understanding these details is just crucial for anyone following this space.
It really is. And, it makes you think. With AI chips evolving so fast and server competition being so cutthroat, what comes next? What's the next big differentiator beyond just being first with the newest chip? What gives a company like SMCI a truly sustainable edge long-term in this incredibly fast-moving landscape? That's something worth pondering.